Hey, how's it going, everyone? Today, let's go ahead and talk about McDonald's, the golden arches that everyone recognizes. Right now, they're going through a sell-off that's been happening week after week for a while. And at its current price of about $267 a share, they're kind of near their 52-week low. So right now might be a good or a bad time to jump in. So in this video, we are going to look at the intangibles, the finances, and run some valuation models to figure out if it's a delicious or a disgusting dividend stock. So I think it's funny how their stock graph right now looks like the golden arches. Eventually, you know that I had to cover McDonald's, as the name of this channel might suggest. And even though I'm a health freak, I still eat out at McDonald's every single week. I consider it my unhealthy cheat meal. And that's because I have a love-hate relationship with McDonald's. It's just that one thing that I can't let go. So a little fact about me. I was raised by a single mom, and there were weeks where she couldn't cook because she was working 2 to 3 jobs. So sometimes she would buy like 10 hamburgers from the dollar menu, and that would be my lunch and dinner for a week straight. So in times of financial trouble, much like Domino's, McDonald's has been a saving grace. And here's a fun fact. Even if a McDonald's burger has spent a week in your fridge, it still tastes pretty good after you heat it up. I know from personal experience, but after like that 8th day, it does taste a little ratchet. Their business model seems straightforward on face value, but check this out. McDonald's, much like Domino's, operates through the hands of franchisees. And a franchisee is basically an entrepreneur. These entrepreneurs who own individual restaurants are responsible for making McDonald's successful, and the franchisees have to run the stores the way that corporate wants them to operate. So each franchisee will partner with field consultants that are responsible for a region or an area. This field consultant is usually going to be a 22-year-old fresh college grad that understands how to do math. And they'll basically tell the franchisees what they have to do in order to meet the standards of McDonald's corporate and what changes they need to implement. So, McDonald's will usually get a franchise fee that will look like about 12.5% of all gross sales as a fee for operating under the McDonald's brand. But that's not the main bread and butter. McDonald's is more of a real estate company than a fast food restaurant. They own some of the world's most expensive land. Just think about it. When you see a McDonald's in Paris, New York City, San Francisco, and whatnot, you gotta think how much their real estate has appreciated since they bought it. And because McDonald's owns the building and the land, they lease it back out to the franchisees. That is a really intelligent business model. And if for whatever reason the restaurant ever decides to fail and the food falls out of favor, I can see McDonald's pivoting into becoming a REIT. They will just rent out their land to other companies. Owning land is a good thing. Just like Costco. I'm an American that lives overseas, and let me tell you, McDonald's is just as, if not more popular overseas than it is in the US. Because think about it. If you're from, China, and you eat Chinese food 365 days of the year, doesn't American food in the form of a Big Mac sound appealing? Every time I ride my bicycle past my local McDonald's, their drive-through line is filled with cars. I'm talking about like 10 to 20 cars every single time. And the catch is, unlike the US where you can get amazing deals on the mobile app, here where I live, I kid you not, they give you deals like 10 cents off the fries or 20 cents off the chicken nuggets. No bueno. Because I know back in the States, you can literally buy a burger to get one for free from the mobile app. Whatever. Moving on. Much like Starbucks, McDonald's is facing boycotts over the situation in the Middle East. And as a result, they missed their sales expectations internationally for the 4th quarter of last year. So if this trend continues, it would have a compound effect for McDonald's because they are banking on international growth, or at least that's why Wall Street is selling out of McDonald's. And don't worry, McDonald's is not just sitting around and letting this happen. They have decided to take back ownership of all 225 restaurants in Israel to make sure that no franchisees will do anything against corporate again. again. But it's not just the boycotts that we need to take into consideration. McDonald's has other headwinds coming its way because less and less consumers in the US are eating out. And here's the catch. Food prices rose 20% from January of 2021 to January of 2024. And that's the fastest jump on record. And I have heard the menu prices are ridiculous at this point in comparison to inflation. Since 2014, McDonald's has increased their menu prices by 100%, whereas inflation has gone up by 31% in the same time period. To me, I think this is a big concern as more and more people are just going to choose to cook at home, right? Disregarding convenience to save money. You can't just keep raising the prices and expect the consumer behavior to remain the same. But I mean, grocery store prices are pretty high too. So what's the option here? To just skip meals and starve? To practice intermittent fasting? Which, by the way, I used to skip breakfast for about 10 years of my professional life. However, as of recently, I started eating breakfast, and let me tell you, my brain is a lot more creative in the mornings now. And honestly, you don't even need to do eggs and all that. I just eat fruits, and that's been good enough. So here's a shout out to breakfast, one of the most important meals of the day, for sure. So what's my opinion on all of this? I think eventually McDonald's is going to be okay. And when I say eventually, I mean in the next year or so. And I say that because I remember when McDonald's made the call to pull out of Russia a couple of years ago, which, mind you, had a huge consumer footprint. I mean, just look at how big Russia is on the map. We're talking about over 800 restaurants and 60,000 employees. Yet, it wasn't as bad as everyone thought it would be. So the 225 restaurants going back into the hands of corporate instead of a franchisee should be more than okay. It's not like they're permanently shutting them down like they did in Russia. And when we take into consideration the market potential for Africa, just look at it. There's literally no locations except for like South Africa and Egypt. Africa still has a lot of growth potential. Besides, a company as big as McDonald's with the brand that they have built over the decades will always find a way to stay on top. Although I hate to admit, I think Whataburger and In-N-Out are fantastic alternatives. So whenever I travel and I find myself in Texas, I always grab a burger at Whataburger. Likewise, whenever I'm in California, I try to grab In-N-Out. But that's neither here or there. I just wanted to let you know that I tapped into their annual investor meeting. And it's hard to believe that this is a fast food company. It has a corporate business vibe from head to toe. And that's not a good nor a bad thing. But their presentation and production value was insane. It was nice. But that's just surface level stuff. The executive leadership team seemed the most excited about their Cosmic beverage brand launching in the second half of this year. And I can agree with their excitement. The drinks industry has super high margins in comparison to fast food. And that's because of the supply chain and logistics behind of making drinks being a lot more cost effective. And when you think about it, McDonald's launching Cosmic is not going to be the first rodeo. They've been selling coffee and other beverages at their restaurants for decades now. Not only that, they have the supply chain infrastructure and logistics, what I just talked about, figured out to make sure that each Cosmic location is going to be successful. But anyways, the leadership also said that their main focus for 2024 was growing their top line, aka the revenue, expanding carefully and giving back to the shareholders. What more would you want to hear as an investor? No, seriously, they have their priorities straight. And what you see on your screen right now is McDonald's stock split throughout the history. McDonald's used to do them very frequently, as you can see. However, they have not done a stock split since 1999. So to sum up their annual performance, they grew their global sales by 9%, and they're very bullish for this year. Now, one of the worst attributes about McDonald's is the high employee turnover and overall employee satisfaction. They're on the opposite end from Costco. I can't say that I have ever seen a happy McDonald's employee. From corporate all the way down to the guy making the fries. Workers quitting or getting fired all the time is terrible for a smooth business operation. Think about how often the manager is conducting interviews and training new staff. That's time and energy taken away from the leadership to do leadership stuff. Here's where I'm trying to come from. If McDonald's were to increase their pay or improve their benefits, I feel like more people would stay and work their way up the McDonald's ladder. And on a side note, McDonald's will start selling Krispy Kreme donuts, which is their way of trying to dominate the fast breakfast scene. And I guess they're trying to appeal to those that have munchies late at night. Getting a glazed donut is probably an amazing feeling if you fit that demographic of getting hungry late at night. Oh, and before I forget, if you have a kid that wants to go to college but finances are an issue, if you work for McDonald's, they'll help pay for school. So if you choose to go to a community college or a nearby in-state school, $2,500 should be really helpful, and you get that every single year as long as you work for McDonald's. Just a call out that I wanted to make. Next, we are going to be looking at the shares outstanding. Is McDonald's diluting the shareholders by issuing more shares, or are they buying back shares? Because if there's less shares outstanding, that means each stock that you own has more quality over quantity. So back in 2009, there were about 1.1 billion shares of McDonald's. However, since 2009, they have been aggressively buying back their stock, and as of today, there's roughly 730 million shares outstanding. It's still a lot, but it sounds a lot better than 1 billion shares. So this is a good thing and a green flag in my opinion. Their dividend profile. So back in 2015, they paid out $3.44 a share. However, as of this year, they're going to be paying out $6.68 a share. So when you think about it, that's a 7% average dividend growth rate. Now, their dividend payout ratio is not as low as Costco or Humana, but it's only 57%, which means it's very healthy and very sustainable. And I would say their dividend yield is pretty good, right? At 2.5%, just shy of it. I mean, it's not the best, but it's pretty healthy and it's good. But here is why, as dividend investors, we should give some respect to McDonald's. They have been increasing their dividend payout for over 48 years. Some of you watching this video, you are not even 48. They have been increasing the dividend payout longer than you've been alive. So based on dividends alone, I think McDonald's is juicy. I love it. Ba-da-ba-ba-ba. I'm loving it. Next, let's go ahead and look at some numbers. First is going to be the revenue. This is what the investors call the top line. So when we look at 2015, McDonald's revenue was $25 billion. And as you fast forward throughout the years to last year, they posted $25 billion. So when you see their revenue being stagnant and being flat in a 9-year period, that's not a good look. So it looks like maybe McDonald's has topped out, like 25 billion seems to be their barrier. So when we look at their revenue, I would label this as a yellow flag. It's not the worst thing in the world, because the worst thing in the world would be their revenue going down every single year. And the best thing in the world would be this $25 billion back in 2015 turning into maybe like $35 billion as of last year, but that's not the case. So we're just going to give it a yellow flag for now. It's neither good or bad. Next, we are going to look at the bottom line, which is the net income. This is where it gets a lot prettier, because back in 2015, McDonald's had $4.5 billion in their net income. And as you fast forward throughout the years, it has been increasing except during the pandemic. And as of last year, now their net income is sitting at $8.4 billion. So when we think about their net income, it's going in the right direction and in the right trend. So we're going to give that a green flag. So the net income is a good story. Revenue, not so much. If you had invested $10,000 into the company in 2014 of January and you fast forward 10 years, then you would have had $38,000, which spits out a CAGR of 13.9%, which means that your money would have grown by just shy of 14% every single year. And during their best year, they went up by 45%, and that was back in 2017. And during their worst year, they went down by negative 4%, which is happening right now. As I said earlier, McDonald's is on a dip. Next up is my most favorite part of the video. We are going to run some valuation models to figure out what the intrinsic price for McDonald's should be.
Well, intrinsic value, in other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
Now, the first valuation model is going to be the multiples valuation. Essentially, we are going to look at their industry peers to figure out a market-derived price for McDonald's. So every single one of these companies are in the fast food space. The median PE ratio for these 5 companies is 22.7. Taking that into consideration with McDonald's current earnings per share of $11.56, their intrinsic value is $262.48, which is not far off from their current trading price. Next up is going to be the discounted cash flow analysis model. Essentially, the free cash flow and the growth thereof is going to give us an intrinsic value for McDonald's. Now, when we look at their free cash flow, it's kind of similar to their net income. It is going in the right direction, except every other year, it seems like their free cash flow is decreasing by double digits. Like back during the pandemic, 2020, which we can give them a pass on because everybody was struggling. And in 2022, it went down by negative 23%. And I think that's also when they decided to hop out of Russia. So that probably explains that. But overall, when you zoom out, their free cash flow is going in the right direction, going from $4.3 billion in 2018 to last year of $7.3 billion. The average free cash flow growth rate is 15.5%. However, we want to play it safe, and we are going to shave a little bit off of that and plug in 9% instead, because if we plug in 15%, we are being way too optimistic. So under the assumption that McDonald's is going to grow their free cash flow by 9% year over year going forward, and thinking about some balance sheet numbers, this is going to give us a DCF price for McDonald's $181.77 a share. Next up is going to be the dividend discount model valuation. Essentially, the dividend growth rate is going to tell us what the intrinsic value for McDonald's should be. So back in 2019, you got $4.64 a share in dividends. And remember, McDonald's has been increasing that dividend payout by over 48 years. And to see an average dividend growth rate of 9.7% for the past 5 years is a beautiful picture. I want to play it safe. So instead, we're going to plug in 6.5% as their average dividend growth rate going forward. So based on that, the intrinsic value for their DDM is $474.28. Now we're talking. However, the next one is the bear model, which is Benny Graham's valuation model. Essentially, the growth rate projection and the current AAA corporate bonds yield rate is going to tell us an intrinsic value for McDonald's. That's going to be $159.57, which brings us to the conclusion. Yo, Jimmy, give the people what they want, which is a drum roll. The intrinsic value for McDonald's is going to be $269.53. Now, Wall Street believes that McDonald's should be trading for about $317 a share. The low estimation is $278, and the high estimation is $355. So when you look at their current trading price of $267, it is undervalued even according to the lowest price target, the bear analyst. It's still lower than that. So we said 269, Wall Street said 317. So after looking at the numbers, taking into consideration their intangibles, and researching about the company, I want to figure out an acceptable buy price. And in order to do that, I want to bake in a margin of safety.
That margin of safety concept boils down to getting more value than you're paying.
So McDonald's current trading price is $267 with a 5% margin of safety baked in. Then my acceptable buy price is $256. But let's go ahead and plug in the Wall Street number as the intrinsic value. So once we do that with a 5% margin of safety, then the acceptable buy price is $301 a share. With a 10% margin of safety baked in, then the acceptable buy price is $285. And if you buy McDonald's at its current trading price, then you get roughly a 15% margin of safety. And you're probably wondering, what is my opinion about McDonald's? Here's what I think. McDonald's is one of those companies that is always expensive because they're trading for a premium. When you look at their PE ratio against their peers like Wendy's, it's always a lot higher. In the fast food space, McDonald's is best in class in their supply chain, in their franchise model, their brand value, and procurement opportunities. Don't even get me started on their McRib. They only introduce the McRib for the season when they're able to procure it at the lowest price possible. They're taking a page out of the Walmart playbook. And I think the growth days of McDonald's are long gone, unless Cosmic, their beverage arm of the business, can take them to the next level. So I think of McDonald's as being a slow and steady, but relatively safe dividend company that happens to be delicious. But here's where you might disagree with me. I think for their price point at $267 a share, there are better opportunities in the market, especially when you take into consideration McDonald's current trading multiple. For a company that is growing as slow as McDonald's, their PE ratio is sitting at 23. However, if their price does reach a low of $240 or even $230 a share, I would probably jump in. But right now, there's a sell-off happening in certain industries, and those companies are prioritized on my watch list. With that said, I have been monitoring McDonald's for over 5 years now, and I think it's a great business, but I would rather keep scooping up Starbucks as of this moment. But that's just me. Please do your own due diligence and research to figure out if McDonald's is delicious or disgusting to you. Because to me, I think it's delicious. However, I do think they're a little overvalued even if they're going through a sell-off. But if you decide to jump in, I can't blame you. I can see why. Anyways, that has been another Dividend Compounders with Cheese video. I will talk to you next time. Stay safe.